Welcome to Level 1 Lesson 3. My name is RIA the Trader from TradingWing.net. Throughout this lesson, you will learn the fundamental differences between investing and trading. So let's get started. As an investor, your goal is to slowly build wealth over a long period of time through the buying and holding of stocks, mutual funds, bonds, and so on. As an investor, you will be making less frequent transactions, which means your transactions will only take place every several weeks, months, or years. The purpose behind investing is to focus on growing a retirement account over several decades. In order to do so, you must diversify your portfolio. You do this by avoiding putting all of your eggs into one basket. And the reason for doing so is that if there is ever a market downturn, your portfolio does not suffer drastically as you have diversified throughout multiple industries. In order to be a successful investor, you must focus on finding companies with significant growth potential. You may want to find companies that are ahead of their time. If you have not heard of the details of investing, you may have heard of long-term investing accounts, such as the Roth IRA, 401k, or the tax-free savings account, also known as the TFSA. If you are interested in becoming an investor, you need to keep in mind that a successful investor returns an average annual yield of 10 to 15%. If I were to give investing a risk level, I would give it a low risk. Now, let's go into trading. As a trader, your goal is to quickly build wealth over a short period of time through the buying and selling of stocks, options, commodities, and so on. You will be making more frequent transactions in comparison to investing. The goal behind trading is to grow an account over several months in comparison to several decades. In addition, you are focused on growth and not necessarily diversifying your portfolio. This will leave a lot of cash unused. However, this can be beneficial as you can avoid losing by avoiding trading during downturns. Obviously, this is easier said than done. However, as you advance more and more in your trading journey, you will become a lot better at avoiding losses. In comparison to investing, traders focus on finding companies with short-term growth potentials and upcoming catalysts. There are several different types of trading styles. There are position traders, swing traders, day traders, and scalp traders. If you choose to become a trader, the successful average monthly yield of a trader is 5 to 10%. However, the risk level is high. Now let's talk about the different trading styles. A position trader buys and holds a position for months to years. A swing trader buys and holds positions for days to weeks. A day trader buys and sells a position within the same trading day. And finally, a scalp trader buys and sells a position within seconds to minutes. Now you might be wondering, what is my trading style? I have set up a list of criteria that may help you determine what trading style may best suit you. In order to better understand what your trading style may be, you need to take into account your day-to-day life. For example, your account size, the time you have available, your experience level, your personality, and your risk tolerance. When I say personality, I mean, are you an emotional person or are you a more calm and patient person? As that is critical when it comes to trading. At the bottom of this page, you will see a list of criteria that I have seen position traders, scalp traders, day traders, and swing traders have. That is at least the successful ones. And that concludes this lesson.